Wonderful. Okay, I hope you enjoyed the coffee break. Let me introduce our next session. We have a strategic dialogue asking the question, is Europe still shaping the global agenda or drifting towards irrelevance? The session will be moderated by Alexander Sarrigeorgiou, Vice President of Insurance Europe and Chairman and CEO of Eurolife. And I'll ask the panel to also come up on stage now, please.
Here we go. Yeah, okay. So is Europe drifting towards irrelevance? That's a nice question to discuss. So let me start by setting the scene. And I always say that sometimes, in order to make progress, we need to be less polite with each other. So let me try to be a bit provocative today and more blunt. Before I introduce our panel, let me just say a couple of words. We tend to talk about today's challenges as if they're new. They're not. I mean, we have wars. We've had wars before. We have inflation. We have anemic growth. We have runaway fiscal deficits in many countries, many major countries. We have yet another, maybe this time unprecedented, but yet another major technological revolution and disruption that will disrupt not only business, but society. These are all things that we've seen before in one way or another, but today they're all hitting at us simultaneously with compounding force at a moment when Europe's weight in the world is diminishing. And while there are a couple of other elephants in the room, very familiar to us insurers, familiar to the public at large, but climate change comes to the headlines whenever there's a natural catastrophe, and then it comes to the main headlines, so the public becomes aware. Demographics, as the baby boomers become pensioners, and there's not enough money set aside, and so we have a yawning protection gap. So here's a number that should make us think. And of course, I used AI to find this. So let's not go. So when Europe started, the idea was to unify. So that was a good thing. My country, Greece, was the 10th member of the European Union. We're now 27. Then we had monetary union. We have the euro. The euro was a success. Even better. So we're doing the right thing among 27 countries. Yet, in 1995, Europe represented 34% of nominal global GDP, and it was ahead of both Asia and North America in 95. Today, Europe is at 25%, down from 34. Asia is at 36, and America is at 30%. So this is not a cyclical dip. This is structural. And in fact, if you read what the experts are saying, they're not talking about a European resurgence maybe coming up. They're talking about India coming behind China to claim a big part of global GDP. And if you do purchasing power parity, the numbers are similar. I mean, the direction doesn't change. So all of this makes me think whether we've done the right things, but are the right things enough? Because Europe is falling behind. We are no longer operating on a rules-based economy. We're operating in a geopolitical economy where security, capital, technology, and resilience all come together. And we live in a world shaped by great power, competition, and Europe And this world is not waiting for Europe to set the agenda. So the question today is Europe still shaping the agenda, or is it just reacting to it? And I think the honest answer is both. Both things are happening. We face a brutal competitive reality, and Europe has great ambition, but the execution, in my humble opinion, is lacking. So what needs to change? What needs to change in the way we invest, in the way we regulate, in the way we position ourselves globally? And insurance is not a side story here. We are perhaps the largest institutional investor with 9.3 trillion of patient long-term capital by definition, the good kind of investor. And of course, we are the ones shaping resilience in view of all the risks that are happening. So this sector is ready to invest, it has the capital, it's ready to invest and build resilience, it's ready to invest and enable growth. And it requires capital, real capital, a Europe that is investable, competitive, and able to be scalable. So it's time to walk the talk, because there's a lot of talk in Europe. And I'm going to close this brief statement by saying, you know, if you read the Draghi paper, the Letta paper, I've had the honor of meeting Mr. Letta recently, they say all the right things, but then when you say how we're going to do it, it breaks into 27 finance ministers, budgets, political cycles, prime ministers, and there, you know, there is the difficulty. So these are the themes we're going to explore today with a panel that I think is extremely prestigious and able to answer these questions. They told me they've all studied very hard. So first of all, Your Excellency, Ambassador Nerijus Aleksiejūnas, permanent representative of Lithuania to the European Union since 2024, coming from a Baltic country on the EU's eastern flank. You bring a frontline perspective on European security, sovereignty, the geopolitics of it all. And you're also involved in council dynamics at a particularly important moment, as Lithuania is going to become president of the European Union after Ireland in a few months. Andreas Schwarz is head of cabinet to Commissioner Zaharieva, responsible for startups, research and innovation. Andreas, you are at the heart of the Commission's work on competitiveness, with the aim to closing the innovation divide between the EU and the global competitors and attracting capital, of which we have 9.3 trillion, into exactly these kinds of investments. Elizabeth Kelleher Dwyer, President-elect of the NAIC, National Association of Insurance Commissioners in the US, and Director of the Rhode Island Department of Business Regulation. Elizabeth, you will bring to us the US perspective from the other side of the Atlantic, and I always say the grass is always greener on the other side. Maybe it's not always greener, so we'll talk about that. So you will offer to us a benchmark for Europe's ambitions, especially as regards regulation, which around this room is a favorite, in quotation mark, topic. And finally, Hannah Gurga, Director General of the Association of British Insurers. Hannah, you will contribute the UK perspective and a very practical view on competitiveness, investment, and regulatory simplification, of which you were free to do as of a few years ago from an insurance industry perspective. So thank you all for being here. Let me turn to you, Mr. Ambassador. So recently, Europe has been placing much greater emphasis on sovereignty and economic security because the international environment has turned riskier and riskier. Over the past decade, how has Europe's understanding of sovereignty changed? And has it responded to the changing environment? And if you had to prioritize, what is the single largest vulnerability of Europe that Europe must address in the next couple of years?
Thank you so much, first of all, for this invitation, kind invitation. It's really a pleasure and honor to address such a noble audience, especially when you mentioned that this sector is bringing more than 9 trillion euros, which is impressive number by itself. Answering to your question, you asked about single, element, and I would say security, security, and security, because that's, I think, the biggest vulnerability what we have now, especially looking from the perspective what you started, that geopolitics is changing, world order is changing in our recent years, and I'm always wondering how it will be reflected in history books, in 50 years or 100 years, how this period will be called and how it will be reflected in the future. But it's clear that many changes happening. And you mentioned different numbers about the role of Europe, which is shrinking in numbers in different senses, but still I think that we have all possible tools to find our place in this new world order and to find possibilities to flourish and to develop our economies. So when I'm saying security, so I have in mind maybe 3 elements. So firstly, what we need to do as Europeans to invest on defense, because in this new geopolitical order, you can be a big economic superpower, but if you don't have military power, it's not very clear how long and how successful you can be. It's becoming some kind of new rule which we need to accept, and that's why we need to invest in our defense. As Lithuania, I think we are showing a good example. When this year we are having 5.4% of our GDP dedicated to defense. I think it's the highest number among all European countries, because we feel that's the right moment, that's the right approach, what we need to do. Secondly, I think what we need to invest a lot on these hybrid threats. Yesterday I just returned back from Vilnius because we had visit of the President of the European Commission. It was a visit to Vilnius, together meeting with our Baltic presidents from Latvia and Estonia. And the main purpose of this visit was how we can react after last week's events happening in our region when the drones were coming to our airspace. It made a huge, I would say, implication to the society, because all inhabitants of our capital, Vilnius, were asked to go to the shelters. And it was, for society, a huge shock in a way. It reminded us, very beginning of the war in Ukraine 4 years ago. And also it was clear that we, even being in the front line, we still need to invest more on different kind of measures, what we need to do on alert system, on understanding how you can respond to this drones threat which is coming from Russia's war in Ukraine. So I think that's one of the second part of my answer on security. And the second answer, I would say, it's still we have this golden age to react, because we need to take very carefully what our intelligence services are telling. And I think German intelligence services is always telling that Russia will be ready to attack NATO countries in 2-3 years. And it's not empty words. It's the same analysis in our intelligent society. And we still have few years to prepare. And the third element, what still we can do, is to invest in the protection of critical infrastructure. Because if one of the lessons learned from the war in Ukraine is that we are having very huge vulnerabilities there. And if drone is coming and damaging your electricity grids, it can be huge consequences for all your societies. And it's very probable scenario which we need to imagine. So we need to be much more serious about energy infrastructure, about transport infrastructure, and how to protect. Now we're spending EU money to build, because Connecting Europe facility is used for that. But we need to think already about next step, how to protect what we are building, not just to build, but to protect, because you can spend billions, but it can be destroyed so quickly and so easily.
So, if you allow me to press on a little bit, if you're sitting in Vilnius, you have one perception of threats, of sovereignty, of all that's happening around you. If you're sitting in Athens, to take my country, you're very far away, you don't have the same worries, maybe you have different sets of similar maybe worries, but different sets of worries. So do you think that Europe is aligned on how it perceives the threat? And so when the time comes to actually walk the talk and make one unified policy, do you find Europe together in this or not?
I think that we are aligning more and more. And if you would talk, with the experts, for example, intelligence services, I would say that it is more or less the same understanding. What we are lacking actions. Sometimes we don't have the same understanding how to proceed quickly, how to proceed with very concrete measures, and that's what we are having some still differences. I was in Athens a few months ago, and I know that you also have perception of external threats coming from different maybe geography, but I felt we have something in common, for example, with Greece, because we're at the external border, we're protecting a European external border, and we understand why we need to invest in the protection, in the defense and security. Then I think what maybe just to put additional argument here, I think of course we need also to invest in economic security as well, because if we want to build resilience of Europe, economic security is also very, very important. And here I have in mind, for example, also our experience with China, because China took coercive measures against us in 2022. They were not happy with our political decisions, and they stopped trade, almost import-export with Lithuania. Lithuania disappeared from customs in China. But for that, we helped. This situation helped us to diversify. We opened 4 embassies in the Indo-Pacific region, and we compensated our losses what we had with new measures and new possibilities. So I think that's another example where we need to be much more serious, as well as energy security, because energy is becoming a geopolitical tool which is used against us. And it was also our experience that we built a LNG terminal, we built a petrol terminal, we made interconnections with Sweden, for example, with Poland, and now when the war started in Ukraine 4 years ago, we were the first country in Europe to stop buying Russian gas, Russian petrol, Russian electricity, because we were ready for this situation. And I think that's another example what we need to do.
Thank you. Turning to Andreas, so if security and economic security is now a top priority, how do you turn, from the Commission standpoint, this into reality? Do you act on defense, on technologies that are critical, on supply chains? How do you get the capital to work in these areas, and with what kind of priorities?
Yes, first of all, thank you very much for the invitation. And indeed, my commissioner, Zaharieva, is in charge of startups, innovation, and research. And we see, of course, this question very much from this angle. And if I could say what is the biggest challenge for Europe is to scale the great startups we have. We are actually producing a record number of startups in Europe, more than in the US. Our venture capital funds have returns that are higher than those in the US. But so far, we really have a challenge to scale some of these startups, which is why they're often leaving to the US or to other geographies. And that's something we have to address in Europe, because making those startups grow in Europe, allowing them to grow in Europe, will help to create growth and jobs, will help to create technological sovereignty. We are too dependent on too many technologies, and also contribute to security. if you see, and that is one of the encouraging things we see for the moment, the creation of defense startups now all across Europe, that's something extremely impressive, where we are building a competitive advantage, also because of the high defense spending that we have. And you see the relevance of that in the war of Russia against Ukraine, where Ukraine, although much smaller and much less soldiers, if you want, are able to fight back due to technology, drone technology, that they have developed. So the role of technology is huge. Perhaps one element I would like to stress, and I'm sure we'll come back later, we are creating the Scale Up Europe Fund, which is the biggest venture capital fund in Europe for growth stage. So tickets of at least 100 million euros in financing rounds up to 1 billion in all relevant deep tech areas, AI, quantum, biotech, but also dual use. We just have selected the fund manager for that. That's EQT from Sweden. And that is, I would say, a flagship initiative. We have an insurance company as one of our investors, Allianz. And we hope that this is the launch of a much broader debate about how to attract more institutional capital to our venture capital system. And you mentioned the 9.3 trillion. I mean, we're talking about pension funds and insurance companies. If we are able to unlock even just 1% of this amount, we solve all financing problems at European level for this sector. So we are very ready to engage in a dialogue also with the insurance sector, how to achieve that, what we need to do to unlock this capital.
So, 9.3 trillion, any kind of percent multiplication results in huge numbers. But let me speak as a CEO of a company in the European Union, and also someone who has worked in the US in a similar role. So VC is great, and I think it's very exciting what you told us about an initial first investment. But for an insurance company to invest in venture capital, there are regulatory impediments, there's capital charges, there's all kinds of stuff, liquidity and so on, the flows. And yes, there may be high returns in the end, but I'm wondering if you have been you in the sense of the Commission have been talking to this end with EIOPA, because EIOPA are the ones who are setting the rules, and we're very happy that we have a very solid framework that guarantees the trustworthiness of insurance in Europe. But within these two organizations, you need to seek the solution. Yeah.
Yes, I mean, this is part of the discussion I think that we should have. We have done a lot of regulatory facilitation. For example, if you invest together with the European Investment Bank, the European Investment Fund, there are now new rules which lower the capital requirements that you need to put aside if you invest in venture capital. Also, together with the EIB, we will develop a curated list of potential venture capital funds with very good and interesting returns. So I think you have said at the beginning that venture capital is not really on the map of many insurance companies. Well, we want to put it on the map because this is a win-win. The returns, you refer to them, are very attractive. With your contribution and your investment, you can really help the innovative economy of Europe, the technological sovereignty. So it is very much a win-win, but I do understand that there are still a lot of questions, and that's why we are launching, we call it European Institutional Investor Pact, where we bring together insurance companies, pension funds, but also sovereign wealth funds to explain to them what we are doing in Europe in terms of venture capital and invite you to invest with us. And again, we are not looking for huge risk exposure. Mm-hmm. If it is 1% of the assets of insurance companies in Europe, we'll solve the financing gap for venture capital in Europe and pension funds. It's very easy. So But we are ready to start this dialogue, and we'll be happy to engage with you on that.
My suggestion would be if you do a case study of investing in XYZ type of investment, and I'm sitting at an insurance company office, I see all the impediments first, and I see a promise of a return down the road, which is not so certain. And naturally, people would tend to choose the easiest road, which will be to buy a sovereign bond or buy something more easy and secure.
With very low returns. With very low returns.
Okay. Thank you. Hannah. So, from a UK perspective, you no longer have Solvency II. So the post-Brexit reforms appear to prioritize more flexibility than we have within Solvency II, and you have more explicit focus on capital release, so you get growth. So the question is, all this on paper sounds right, and if I look at your situation, the UK, post-Brexit, could take all the best parts of Solvency II and make it more efficient, etc. The question is, have the changes you implemented really changed investment behavior? Is there anything to learn from your experience? I'm sure there is.
Thank you very much, Alex. It's a great question, because I think at its heart, what it's getting at is how can the prudential regulatory framework, whatever jurisdiction, how does it balance driving growth with the important policyholder protection that people rightly expect? And in the UK, we saw that debate play out over several years as the then UK government started the review of Solvency II, thinking how can this be revised to better meet the needs of a UK market while protecting policyholders but also driving investment. And then you have that tension between what's the political objective and what's the regulatory objective. Because the regulators have a primary objective in the UK, they have many secondary objectives and have regards as well. It's a complex balance for the regulators. Where we landed in 2024 was Solvency UK, and that introduced two important changes. The first was to the risk margin, where there was pretty broad consensus amongst the industry as well as the regulator that the calibration was not appropriate, that it needed to be reduced to avoid having an artificial constraint on capital. And that did go a little bit further than in Europe, but that reflects the needs of the UK market. The second change was with respect to the matching adjustment, which has been made more operationally workable, is how I would describe it. And the big debate which played out right on the UK stage, even as we were going through changes of administration at that time, it featured Solvency UK in the campaigns for the Conservative leadership contest, which is not something I'd ever expected it would get that level of attention. But the matching adjustment, in practice, the change that's been introduced means that we've moved from a fixed cash flow to a highly predictable cash flow, which is a meaningful step forward. But even now, as an industry, we would like to explore the potential for that to go further, because when it comes to investment, there is a limit to what you're able to invest in with an insurer's balance sheet if you're just looking at debt. We would like to see if it's possible to introduce some kind of an equity component. But all that being said, for me, I run the ABI, we represent the UK insurance, pension and long-term savings industry. The reforms to Solvency UK were welcomed, but we knew that as an industry we needed to play our part. And that led us to commit 100 billion of investment over the 10 years following those reforms. In the first year of reporting, the industry had invested £10.9 billion. That was in UK productive infrastructure across real estate, utilities, transport. The ABI is continuing to track that, and we're on a good trajectory. But there are opportunities for us to go further and faster, as I say, if we can look again at the approach to the treatment of equity under the matching adjustment. I know, Alex, you're very keen to try and draw a distinction between the UK and the EU, but I think I would be very foolish to provide any commentary on that. My perspective as an industry representative is that insurance is a global market. We've heard already today from representatives from a number of countries, including Bermuda. And I think what we're seeing is the same issues are playing out whatever the country. How do we balance the need for growth? How do we leverage insurers' balance sheets in a way that policymakers and regulators can feel confident that policyholders won't lose out?
What you're telling me is there's no magic wand that you can...
Well, I'm very interested to hear actually what Andreas was saying about the venture capital, because also what we've seen, I mean, with Solvency UK, really what we're talking about is the annuity books, we're talking about debt financing. The current government also has a strong growth mission, and they are very keen for us to invest more in private markets, so it may be something that I pick up with you later to learn a bit more about the approach that you're taking.
You know, I was talking to a banker friend in Athens last week, and he was telling me if he wants to raise debt, he goes to Frankfurt, to Paris, wherever he can raise as much debt as he likes. If he wants to raise equity, he has to go to New York, he has to go to Boston. So that is, I don't know if Andreas is looking at me sort of critically, but that is sort of coming from the market. And I'm wondering if you had to pick one reform to magically unlock private investment, what would it be, and what would the world look like after that was implemented?
Me? Shall I reply?
You can do the reform.
Look, it's very difficult to name one, but finance follows opportunities. I believe that venture capital is a business case. And we were 4 weeks ago with the commissioner in the Bay Area, and we actually saw a lot of US venture capital funds who are interested to come to Europe and invest, because the US market is very saturated. A lot of venture capital chasing, few startups. Europe is still a gem where you have a lot of great startups, but not so much venture capital. So a lot of the venture capital funds, and they are looking for European investors. So some of the insurance companies will certainly be approached, and I'm trying to also broker the contracts. But that means for startups to be successful, they need demand. So one huge reform that I think we have to think of in Europe, and this was the recipe for success in the US, to use much more public procurement, innovation procurement, pre-commercial public procurement to create demand for startups. Because if startups have demand, they will get the financing. The financing always follows. So from that perspective, that is for me the route that could really boost even more the European startup market, and therefore also lead to more private financing. And we see it. For the Scale Up Europe Fund, we also have interest of UK investors now. We have interest of Singaporean investors, American investors. A lot of things. We expect the demand for startup capital in the next 10 years to triple in Europe, in particularly in late stage. This is a growing market. This is a very interesting market with interesting returns. And no, I'm a convinced market economist. I believe the market will go where the profits are, and we hope some of the insurance companies will be part of this.
Thank you. So Elizabeth, we move to the other side of the Atlantic now. Again, if you use AI, but we kind of knew that before AI, to have an insurance company in Europe versus in the US, you need 3 times the capital. Now, those of you who are actuaries, don't come to me saying that that is not actuarially totally robust. It's roughly there. You need a lot more capital to have an insurance company in Europe than in the US. So, can you talk to us about the US? Is the grass greener there, and is life free of regulation, and everybody is making money.
It's just amazing, yeah. I don't know enough about the European system to really make a comparison, but I can tell you what we do in the U.S. So I know, you hear we have 56 jurisdictions all attempting to regulate. What we really have is a national state-based system. So the 56 jurisdictions have agreed on one group of financial standards. It's a risk-based capital approach, and through utilization of the NAIC, we change those standards as things change. So it's actually a pretty nimble system. You will be subject to the same regulations, financial regulations, whether you're domiciled in California or in Rhode Island. We will implement them. Rhode Island implements it for our domestic companies, California for their domestic companies. But it is the same financial standards. And that's one thing I hear a lot in Europe, the lack of understanding. They think, when you hear 56 jurisdictions, you're like, how could that possibly work, right? 56 different standards. It's not 56 different standards. But the way we're set up through the NAIC, I think we're able to be pretty nimble when things need changing. Those issues are discussed by experts within the various state jurisdictions through the use of the National Association of Insurance Commissioners, and we change the risk-based capital formulas. And our goal is matching risk to rate. So when we start hearing, well, that is much too high a capital standard, we will investigate that and possibly adjust it. We won't always adjust it because sometimes that's the capital standard you need. But a couple of the things that jump out at me, at least, that are different between Europe and the US is we really focus on the statutory company as opposed to the holding company. So we certainly look at the holding company, but we're really looking at that insurer in and of itself, and then looking at the overall holding company. I think that Europe looks at it a little bit differently. I think you look more at the holding company down. We also have differences in our valuation approaches and our public disclosure requirements. We have very different perspective on the use of internal models than Europe. We also have a number of different tools at our disposal that other jurisdictions don't have. And we leverage off each other quite a bit. We'll have, I might have one domestic company within a holding company, and there are 3 or 4 other jurisdictions that have the other domestics. We all work together on the financial analysis and examination of that company, bringing different perspectives. And it seems to work out well, that diversity of opinion and all of that. But we have, over the years, I think that we have come to more through the IAAS. There's a number of things that we've worked with IOPA and a number of things on a number of different standards, such as the ComFrame, the insurance core principles. And I think in that way, we're trying to bring everything closer together. So I don't know about I'm going to accept what you say, that it takes 3 times the capital. But what we're really trying to do in the US is make sure that the capital is appropriate for that particular company. Mm-hmm. So we'll have minimum capital standards. In my state, the minimum is about 3 million. But that's not the answer. That is simply to set up a shell company. When you come to my state and you want to set up a company, we do a complete risk-based capital analysis. And that's when you know the amount of capital that you're going to need. Not by statute, not by a set amount, it's by what is the risk that you're taking on as an insurer.
So as the world is changing very rapidly, and the US has a long history of consumer protection, you alluded to adjusting the standards. If something comes up, you look at it and you may change it. In Europe, we have Solvency II, and I repeat, I'm personally very happy we have Solvency II, but Solvency II gets revised every few years. Are you implying that you sort of change things on the go, or you change them? You have a system that you revise every few years?
So it's certainly not on a yearly basis or a monthly basis. When an issue comes up, we start looking at it. So is it, on a very, very quick? No, these are things we really look at, again, because of consumer protection. You don't want to change any financial standard on the fly, but we're not on a set revision standard. So right now, our past president, John Gottfried, set up a risk-based capital task force 2 years ago to look at all of our risk-based capital standards. Are there any, we're doing gap analysis right now. Are we appropriately looking at our financial standards, considering the changes in the market, some of the things that you all have discussed, the different types of investments, the different types of companies that are investing these days? Do we need to adjust anything? And that is up or down. So it's more of a constant look at each individual standard and whether or not that is continuing to work in the market.
So I'm tempted to ask you here, as the US from the top is moving towards deregulation, how do you view Europe, and are we diverging? What do you expect from Europe on this front?
So I would say that we are moving to appropriate regulation as opposed to deregulation. So I think we're very sensitive to look at regulation that simply exists but doesn't actually get anywhere, right? So the type of things that companies complain about, and I'm not saying that everything that companies complain about are something that needs to be fixed, but what is the purpose of the regulation and what does it accomplish? And if it does not accomplish something, let's change that. So we kind of have that continuous improvement attitude. One thing, ironically, that works for us is, I'm sure you've all heard that there's a big divide in the United States politically. You might have heard that. When we have a new standard, it is voted on by the 56 insurance commissioners. That means that the commissioner in California and the commissioner in Georgia have to agree. And that actually brings us to a really non-political place. And I think that actually works in our favor, that we really have to come to common ground. But I definitely would say, and I don't think this is even a recent thing, we look at why we're regulating something and how we're regulating it. If the why isn't there, we shouldn't be doing it. If the how should be changed, we should change that. The mere fact that it exists doesn't mean that it should always be. In other words, we don't want that, we've always done it that way approach. We want to look at each regulation and see how it's affecting the industry.
Let me ask Ambassador, let me ask you the last question as the time is running out. Lithuania is going to be European president in 2027. And Europe is really at a very critical stage right now, as there are too many balls in the air, and some of them may be explosive. So where can Europe realistically move the needle? What do you envision success looking like for Europe in the global stage in the years to come?
Thank you so much. Yes, we'll be running presence in the first semester of 2027. Time is approaching so very quickly. It is huge responsibility, but also I think it's very important opportunity to do that. We have 5 priorities, what we already decided in Vilnius. So the first one I explained a little about security and defense, which is quite natural thing to do for Europe, to be quicker, to be more decisive, to invest more. Second priority will be competitiveness and the MFF, because MFF, for me, it will be a litmus test how much Europe is serious about all these new threats coming, but also how serious is to invest in competitiveness, invest in startups, invest in this ecosystem, which could bring for us future economic development. And coming from Lithuania, where I would say innovation system is very, very well developed. We have a lot of digital services in our region. We are also very advanced on the cybersecurity. And I always struggling that, when we talk with Lithuanian unicorns, how to keep them in Europe. They always, have this trend to look to US, and I think we need to be much more serious about keeping them in here, because that's part of our competitiveness. We are used to have, direct payments for farmers, but why not to have direct payments for startups in the future? So that will be a little bit ideas, because I would say saving and investment union will be also important dossier on our table, and I believe that we can do that a lot in this sense. The third priority, very quickly, just to say that it is EU enlargement. We believe that Europe can become stronger when it is becoming bigger. Even you mentioned numbers, but one of the answers is to become bigger and to have bigger numbers in the global stage. The fourth priority is how to build resilience of our societies, how to protect mind of our people against disinformation, against, I would say, different attacks what we see now in the recent years. And the fifth priority is social agenda, because sometimes we are talking a lot about competitiveness, about defense, but we are forgetting this social angle, which is also very, very important, because we are losing, voters in the elections, and I think all parts of our society should feel, benefits of European project. It should be a part of all this progress what we see. Europe is always making progress during difficult times, not during best times. So I feel that the presidency will be exactly this moment when we can move forward on competitiveness, on MFF, because the size of the budget will be also decisive. You mentioned about 9 trillion coming from your sector. On EU budget, we're talking about 2 trillion in 7 years. Whether it's big budget, I'm not sure. So if we are serious about the necessary steps, I think that we need to keep an ambitious EU budget the next 7 years to come.
Thank you. I was going to make some closing comments, but I think these are the best closing comments still, if you allow me. I think it's clear that Europe has talent, Europe has capital, Europe has values, Europe has sophisticated regulation. We have all the ingredients to attract investments, put more of that 9.3 trillion at work for infrastructure, for resilience, and move forward. We also heard from our colleagues in the UK and the US that there are no magic recipes. You can tweak different recipes and approach reality from different viewpoints, but the principles are the same and reality is the same. So if you allow me to close with a slogan, I could say that our task now is to make Europe sexy again. So with that, thank you very much.
Thank you.
You.